Good evening, everyone, and I extend you all a very warm welcome to this 18th webinar series, which is an educational initiative jointly undertaken by PhillipCapital and BSc with the sole objective of sharing knowledge and market insights for everyone connected to global markets. Dear all, we at Phillip Capital are committed to undertake many more such education initiatives and help the market participants in the managing the volatility and achieve their goals. It's indeed a pleasure to welcome all of you and thank you so much for taking your time out to be present in this webinar. My name is Preeti and I'm a part of FX Advisory Desk at Phillip Capital. We are established in Singapore in 1975. We are one of the Asia's leading financial institutions with a global reach, having presence in 15 countries. Our asset under management worldwide more than USD 35 billion, and we have over 1 million clients worldwide. At this onset, I would like to thank Ms. Rajani Sinha and Ms. Ojas Shah for sparing their valuable time for consenting to be part of this webinar series to share the valuable market insight. Mr. Ojas Shah is the DGM at BSc. Now I would request Mr. Ojas Shah to share his part of the speech. Thank you.
Thanks, PhillipCapital, for organizing such a wonderful webinar. This is the need of the hour. The topic is impact on the global turmoil and Indian economy. And most of the participants are very much interested to hear views of the expert panels on this. So before we start the session, let me give brief about what BSc is. I mean, BSc does not need much introduction, but let me give a formal introduction. So established in 1875, BSc is Asia's first and world's fastest exchange in terms of the speed of 6 microseconds.
So you gone on mute.
Now it's audible?
Yes, sir.
Okay. So BSc does not need much of the introduction, but let me give a formal introduction. So BSc was established in 1875. It is Asia's oldest exchange and world's fastest exchange in terms of speed of 6 microseconds. In terms of the client base, more than 12 crore clients are registered with BSc. And it has a popular index called Sensex, which is widely being tracked across the industry. In terms of the listed capital or listed companies, BSc has the highest number of listed companies in the world. And in terms of the market capitalization of all these listed companies, it is more than 3.5 USD trillion dollars. So this is where BSc stands. In terms of the product offerings, BSc has a wide range of product offerings that includes equity cash, derivatives, currency, commodities, mutual fund, insurance, IRD. So a whole lot of bouquet of financial products are being offered by BSc. And recently BSc has launched a product on electronic gold receipt, which is more of a spot market product. Basically, you get a price which is almost closer to the price of the spot market in the gold. So that product is also been launched, where the retail participants can buy in 1 gram, 2 gram, whatever quantity, and get the price of the spot market. So that is also one of the retail related product which BSc has recently launched. Now coming to the currency derivative segment, BSc has lately started the currency derivative segment in 2013, but has gained incremental market share in the currency derivatives and has a lot of products like USD pairs and other pairs available with us. In terms of the product offerings, we have weekly and monthly futures and options contract both available at BSc. While in terms of cost advantage, BSc is 1/4 of basically the competition charges. Like in currency futures, BSc charges just 25 rupees per crore, while the other competition exchanges are charging more than 90 rupees per crore with same kind of liquidity. There is no difference in liquidity, but we are 1/4 of the charges in futures. Similarly, in options, BSc charges just 100 rupees per crore premium of 1 crore, while the competition exchanges are charging 3,500. So there is a lot of benefit in terms of the transaction charges, in terms of technology, in terms of service approach. Everything is available at BSc. And this lower transaction charges coupled with superior technology makes BSE preferred platform for currency derivatives. Most of the stakeholders, including the corporates, the retail, the proprietary desk, the institution desk, and importers and exporters, all participate in BSE currency derivatives. I request all the participants to have a look on BSE currency derivatives and start aggressively participating in this. I'll not take much of the time, and I'll ask the next speaker to take it forward. Thank you.
Thank you so much, sir. Now I would like to invite Ms. Rajani Sinha. Ms. Rajani is the Chief Economist at CareEdge Group. She has around 2 decades of varied experience of economic research in corporate sector, financial services, and consultancy. She has in the past worked with institutions like Aditya Birla Group, Knight Frank, Kotak Bank, and JM Morgan Stanley. She regularly writes opinion pieces for business dailies on varied economic issues and love to give lecture on economics at educational institutions occasionally. She is an alumna of Delhi School of Economics and Lady Shri Ram College. It is indeed a pleasure to have you on this panel. I welcome you once again. Thank you.
Thank you, Preeti, and thank you to PhillipCapital for giving me this opportunity. And a very good evening to everyone. I have a presentation, so let me share that, and then I can use that as a base to discuss my view on what's happening in the economy currently and what impact do I see of the global turmoil. Okay, so everyone can see the screen?
Yes, ma'am.
Okay. So we are all aware that globally there's a lot of turmoil going on. And now the big question is, how much will India get impacted by this turmoil? And for how long can we remain unscathed and keep recording the decent growth that we have been recording in the last couple of quarters? So before I move to India and talk about how the Indian economy is faring, I will very quickly go through what's happening on the global front. So globally, if I look across, most of the developed and emerging economies are going through a slowdown, and there is increased fear of recession all across. Over here, I have put the quarterly GDP growth for the major economies, and as you can see, growth is slowing everywhere. And for an economy like US, which had contracted in the first 2 quarters of this year, in the September quarter, again, the economy has recorded positive growth, but that's mainly because of one component, the net trade doing well. Otherwise, if you look at the overall economy, it's expected in the fourth quarter, again, it would slip to contraction. Um, Look at EU, growth is slowing mainly because of huge exposure and impact of the Russia-Ukraine war and the energy crisis that the EU is facing because of that. China, again, a slowdown. One, because of their zero COVID policy that they have been following. Second, also the property sector over there has been very, very deeply impacted by the pandemic and also by other developments, which is then very adversely impacting the overall economy. So Chinese economy in a very bad shape. Japan, again, if you see the last quarter data that we have, it has recorded a contraction. And that's mainly because yen has weakened very sharply against US dollar. And that has resulted in their trade deficit widening sharply and eating into GDP. So broadly, the story is, the theme is that all across this slowdown happening. For some economies, the reason are specific, but if I look at the broad theme, one broad theme is high inflation. Most of these economies, developed as well as emerging economies, are struggling with high inflation. And developed economies, which are used to around 2% or so of inflation are currently going through a phase of very high 8 to 10% of inflation. And that's eating into purchasing power of households. Now, if I look more closely at the inflation story, if you look at the first graph here, it shows for these economies what are the broad components and what's the inflation in those components. And as you can see, clearly energy price is a big factor which is driving up inflation all across. Energy is reflected by the black bar here. But the important point, so that's not surprising. We are all aware that crude oil prices had been high, overall energy prices have been high in the last year or so. But what is important to note is that if I look at core inflation, inflation after excluding the volatile component of food and fuel, core inflation, which is reflected by the turquoise bar, if you look at that, that is also at a much higher level than what these developed economies are used to. So as you can see, for most of these economies, it's in the range of 5 to 6%. And like I said before, these economies are used to 2% inflation. So with core inflation at 5 to 6%, they're talking about very high inflation, which is very worrisome for them. And core inflation being high also reflect that overall inflation, which started because of supply bottleneck, has got more deeply entrenched in the economy. And we are also seeing high demand side inflation, and that's a big cause of concern. And then the fallout of this is, as you can see from the second graph, the central banks all across have been very aggressively hiking interest rate. And in fact, what the US Fed does on that front is going to have an implication for a whole lot of other economies, including India. So recently, while Fed has been very aggressively hiking rates, some of the data points that have come from US, like the CPI, the producer price index inflation, both CPI and PPI inflation were little lower than expectation. So this has led to increased expectation that maybe Fed will now, the pace of increase that they had been following so far of 75 basis point, maybe they will moderate that. But it's difficult to say right now because some of the other indicators from US is showing that the economy is still quite heated up. The retail sales data, which has come recently, has recorded higher than expected growth. The labor market is still very tight. We will see some impact of all these layoffs in the tech sector that has been announced recently. But so far, the data is still strong. Hence, and US Fed, if you look at the Fed members, they have been indicating that they are not given any indication of moderating. So probably we should be prepared for aggressive rate hikes going forward. And hence, all other emerging economies, in fact, developed economies also, have to be accordingly prepared with their monetary policy and how their economies are going to react to the rate hikes that they have been announcing. So now, apart from global growth, which is slowing down, inflation, which is very high, the other critical factor which is going to impact us is what is happening to global commodity prices. And here, as you can see, commodity prices had shot up very sharply in the beginning of the year. There was a lot of supply bottlenecks just after the pandemic, and then the war aggravated that. And we saw commodity prices shooting up to record highs, and all across, from metals to energy to agri, all commodity prices were at a high. Now, if you look at the first graph, as you can see, in the last few months, commodity prices have eased, which has been providing respite. But having said that, the prices are still high compared to last year. So commodity prices have fallen, but still they are high if I compare it to a year ago period. If you look at the second graph also, it shows that in the last 3 months and 6 months, commodity prices have fallen almost all across the segments. But the important point to note here is that concern on commodity prices, the risk still remains because there's still a lot of uncertainty globally. And hence, there are risks that some supply bottleneck can erupt again, and that could result in prices again flaring up. Otherwise, the commodity prices have gone down mainly on concerns of growth slowing down, global growth slowing down, demand slowing down. On that expectation, commodity prices have gone down. But given that still there's so much uncertainty and there are risks to supply chains, the risk remains that we could see any of these prices flaring up. And especially with crude oil prices, what we have been seeing in the last few months, it has been very volatile. So that's something which would have a very deep impact on Indian economy. And the other thing which has been having a strong impact on Indian as well as many other economies is what's happening to US dollar. Because Fed has been very aggressive with its rate hikes. And that has, if you look at the first graph here, it shows the dollar index. And as you can see, dollar index has been consistently strengthening. And now that has resulted in other emerging market currencies weakening quite strongly. And that's leading to a whole lot of problems in these economies in the form of imported inflation and many other concerns in terms of their external debt position and etc. Now, and that is also causing other economies also to increase their interest rate. So the other central banks, so most of the economies also are struggling with high inflation. So they would also have looked at hiking interest rate, but now they're compelled to do it faster and higher than maybe they would have done otherwise, simply because US Fed is doing that, and they also have to balance the interest rate differential with US Fed to ensure the movement in their currency. So currency is another angle which is impacting the decision by many central banks, and that is impacting overall what's going to be the impact on other economies. So here again, one more important thing to note here is that before I move to the next slide, if you look at the second graph here, it shows that not just Indian rupee, all other emerging market currencies and also other major currencies like yen and the euro have weakened against US dollar. And in fact, if you look at the rupee weakening, it's relatively less than what we have seen in some of the other currencies. Now with that, I will move to how do I see the India economic scenario. But before I talk about, before I go to the next few slides, I just want to highlight that in midst of all this turmoil, now there's too much of interlinkages that we have with global economy. So if we are talking about a global slowdown, a global recession, it's not possible that India won't get impacted by the slowdown. So definitely there will be an adverse impact. But at the same time, if you look at the macro fundamentals, if you look at the kind of economic growth we have been recording, it's still relatively better than what's happening all around us. So the big question is how much will we get impacted? Because definitely we will get impacted by the global turmoil. The only question that needs to be answered is how much will the impact be? And here I want to highlight that compared to the previous crisis, this time there are some fundamentals which are in favor of Indian economy, which have been supporting Indian economy in midst of all this volatility. And one of that fundamental is that our corporate balance sheet is in a much better shape. This deleveraging which has happened in the last few years, so corporates are in a much better shape. In fact, if I look at our credit ratio, which basically looks at ratio of number of upgrades to number of downgrades that we do, in the first half of FY23, this ratio is at an all-time high. This ratio is at a level more than 3, which is at an all-time high level. So this basically shows that we are doing 3 times more upgrades than downgrades, which we are doing. And it's also reflective of, like I said, good corporate balance sheet. Secondly, the banking sector is also doing well. The NPAs have been falling. So bank balance sheet is also in a good shape. Third, on the external front, we also have accumulated high forex reserves, which has In the last few months, it has supported the economy. I'll talk more about it later in my presentation. But broadly, I would say that this time, while the interlinkages with global economy is strong, but this time there are some fundamentals, there are some parameters which are in favor of Indian economy, which will help Indian economy go through this global turmoil much less impacted than it would otherwise have been. Now, with that background, if I look at what's happening to the economy, firstly, I would like to discuss this. This is something which we call CareEdge economic meter. And this is an index which has been created from some 18 high frequency economic indicators. So we have basically all the economic indicators like IIP, GST collection, exports, imports, inflation, unemployment, bond issuances. So a lot of these economic indicators which are released on a monthly basis, we have looked at all of them and put them together to come up with this index to kind of gauge how the economy is moving. And if you look at the red line here, that shows the FY23 trend. And firstly, the important thing to note is that if I leave aside FY21 and 22, which was impacted by the pandemic, and if I just compare it to FY20, which is the dark blue line, you can see that overall there is a positive growth compared to the pre-pandemic period also. So it's not just compared to last year and the year before that, but compared to pre-pandemic period also, this index of putting all these 18 economic indicators together and creating this CareEdge economic meter index, this is showing a growth compared to the pre-pandemic period. And this is also getting reflected in our Q1 GDP data. The Q1 GDP data also has recorded some 4% growth when compared to the pre-pandemic period. So that's a positive, that we are recording a positive growth even compared to the pre-pandemic period. Now the important thing will be that yes, we are recording growth, but the critical aspect will be how is the consumption story panning out? Because consumption contributes more than 50% to our GDP. And what happens to consumption, how the consumption wheel is moving, will impact overall economy. And here we have kind of a mixed picture. If I just look at the GDP data, the Q1 GDP data which has been released, the consumption GDP has grown by some 10% or so compared to the pre-COVID period. So that's a big positive. Now, if I look at some of the high frequency indicators, auto sales, GST collection, these indicators have been recording good growth, and they are also reflective of consumption in the economy showing improvement. But at the same time, if I look at some other indicators like say IIP and IIP consumer goods and consumer durables and non-durables, there we are still seeing weakness. On a YOY basis, it's still contracting, IIP consumer durables and non-durables. If you look at the first graph here, I have looked at IIP consumer durables and non-durables compared to the pre-pandemic period. If I compare it to the pre-pandemic period, 2019 level, and see what's the growth, I find that consumer non-durables is still contracting. And so it's a mixed picture on consumption front. But yes, definitely there is improvement happening as reflected by consumption GDP, but probably not to the extent to which we would have liked. And here the story is that looks like rural demand is still weak. And that's mainly because if you look at what has been happening in the rural economy, the rural if I look at the some of the major agri production, rice and wheat, both have been impacted this year. Wheat by some major heat waves, and rice by excess rainfall or less rainfall in some regions, rice producing regions, and hence the rice production is also kind of like say some 5 to 6% lower than last year. So the rural demand is still weak. And another reason, apart from agri production getting impacted, another reason is that a lot of workers during pandemic had moved to the rural areas, and not all of them have come back. Some of them are still working in agriculture sector, and there's a lot of disguised unemployment in the rural area because of that. So these are the factors because of which we are still seeing and also not to forget the very high rural inflation that has also been eating into rural demand. So broadly taking all these factors into account, the rural demand is still not very strong, but yes, it is improving, as we can see from what the FMCG results that we are seeing and performance that we are seeing, that even on the rural front, demand is improving. Other interesting thing I would like to highlight is if you look at the second graph here, this is based on RBI household survey. And this, the net response basically shows the number of people talking about increasing their spending, net of the number of people talking about decreasing their spending. So this is basically the net response, a difference between increase and decrease. And if you see, while people are overall optimistic on spending, that is improving. But if I look at non-essential spending, they are still very cautious. The non-essential spending is reflected by the red bar here. And as you can see, households are still cautious on that. But even that has been improving. If you see like quarterly, if you look at this data compared to Jan 2022, if I look at the situation in September 2022, that is improving. But still, this is to highlight that households are still cautious when it comes to non-essential spending. But having said that, if I look at the very high income category, which has been impacted less by the pandemic, they are splurging on non-essential items. And there's a lot of pent-up demand from that particular income category. So that's on consumption. Investment is being led mainly by the government. If I look at government capex has been very healthy so far. It has recorded growth of around 50% or so in the first half of the year. Government has achieved around like 40% of its capex target for the year. But if I look at state government capex, it's still lagging. In the first half of the year, it's recording a very marginal positive growth of 2% or so. So state government, in spite of all the push given by the center in the form of that 1 lakh crore of interest-free loan, the state government capex has still not picked up in a big way. And in fact, I would highlight that of this 1 lakh crore, around 60,000 or so has already been approved, and so money has started flowing from center to states, but from states the capex spending is still not picking up pace. Though for state capex always picks up in the second half of the year, so we could see some improvement happening, but so far it's quite lackluster. Now, if I look at overall what's happening on capex, there are some indicators which are pointing towards the capex in the economy improving. If I look at indicators like IIP capital goods or capital good imports, they are all showing improvement. And as I mentioned earlier, this deleveraging that has happened, capacity utilization level in the manufacturing sector is at 75 level. So they are ready for investment if this demand growth momentum is maintained. So we feel that in the next couple of quarters, we should see private capex also picking up. In fact, if you look at the second graph here, it shows the new investment projects announced. This is CMI data. And it has gone down in Q1 and Q2 when compared to Q4. But the positive aspect here is that of the new investment projects announced, if I look at private sector participation, it has shot up to around 90%, as against 65-75% that we had in FY22. So that is a positive, that private sector is showing intent to invest. New investment projects are being announced by them. So that's another factor which gives us confidence that going forward, we could see improvement in capex. And to add to that, like I earlier mentioned, commodity prices globally have gone down. So that is another factor which should be supportive of capex picking up going forward. Very quickly on inflation, if we see what's happening, Inflation is a concern in India also, as I spoke about the global concern. But here the level is lower than what is happening globally. Globally, their target is 2%, and they are struggling with 7 to 10% of inflation. Whereas in India, our range, the target range is 2 to 6%, and we are currently a little below 7%. So it's not as big a problem as it is globally, but yes, given that inflation is above RBI's target band, it is concerning. But in the last few months, there are positive developments here. If you look at the WPI, again, which it's reflected here in that blue line, and that has gone down in the last few months, and that's mainly because of global commodity prices going down. CPI has also gone down, and in fact, like I mentioned, it has gone below 7%. But CPI, there are two factors which are still concerning. One, that CPI domestic inflation is high. CPI food inflation is still high. And now the high food inflation is mainly because of domestic factors. Because, like I mentioned, because of this agri production being impacted, the inflation that we have in rice and wheat are quite high. So food inflation is high, and now I'm talking mainly because of domestic factors, and not because of global, edible oil prices being high and other things, which was the case few months back. Now it's a completely domestic story. A lot of we are seeing high vegetable inflation, fruit inflation, cereal inflation, and that's because of climatic conditions here. The rainfall that we had and excess in some region and less in some region, heat waves and all those reasons. So we have high food inflation, and the other concerning part is that core inflation still remains high. So core inflation is still around 6.2% or so. So the inflation in India, which started because of supply side factors, has got entrenched in the economy, and now we have very high core inflation, which has been sticky at 6% or more for quite some time now. And apart from just goods, there is also high inflation in service sector because of strong pent up demand there. So overall, that's the inflation story. Going forward, we will have comfort on inflation, mainly because of base effect. So RBI will manage to get inflation in below 6% by the end of the fiscal year, mainly because base effect is going to be supportive. Global commodity prices going down and WPI inflation in India going down will also ultimately support CPI inflation. But having said that, the concern remains that core inflation is not inching down, which kind of warrants that RBI still needs to take more monetary policy measures. Now, if I look at the external sector, with the slowdown that we discussed earlier, obviously Indian economy will get impacted. And as you can see from the first graph here, our exports have got impacted. Over here, I have looked at the growth in non-oil exports to remove the impact of crude oil prices being high and supporting our exports through high refinery prices. So if I exclude oil and look at non-oil exports, exports have contracted by around 18% in the last month, the last data that we got for October. And even if I look at overall exports, including oil, it has contracted by some 16.6%. So definitely a strong concern on exports front. And that's because, if we look at our exports region-wise, it has been impacted all across because there's a slowdown happening all across, and that has impacted our exports. And with exports slowing down and imports remaining high, this has resulted in our trade deficit widening. So one reason for imports remaining high was, one, our demand is improving, and second, also because commodity prices were high. And that was also impacting pushing up our imports, because our imports have a high correlation with commodity prices. So, and hence our imports have been high, and that has resulted in widening of the trade deficit. And in fact, if I look at the first quarter GDP data, net exports is a strong reason. It was a strong deterrent for the economy. That was one factor which kind of shaved off from our GDP, the widening of net exports. And going forward, also that would be a concern. But having said that, the positive is that if commodity prices continue to ease, there would be some comfort on imports on that front. But yes, exports weakness is likely to continue. And in fact, we're expecting the CAD, our current account deficit, to widen to around 3.6% or so in FY23. And now this is happening at a time where capital account is also facing the challenge of volatile FII flows. If you look at this second graph here, we have been seeing FII outflows for most of the last 1 year. And in fact, only in November and in August, we had got good positive FII inflows. Otherwise, we've been seeing FII outflows, and that's mainly because of US Fed rate hike, because of which a lot of money is flowing back into the US economy from emerging economies. But so this is having a strong impact on our capital flows. But the other big component of capital flows, which is FDI flows, that has been strong, as you can see from the first graph here. But net, we are expecting our balance of payment to move into deficit in FY23. So with that, our overall Forex inflows reducing, our Forex reserves have been depleting. So one, overall Forex inflows have been reducing. And second, RBI has also been intervening in the Forex market to prevent the rupee from depreciating very strongly. As I discussed earlier, the weakness in rupee that we've seen is relatively less than what we've seen in many other emerging economies. And one of the reasons for that is that RBI has been intervening in the Forex market. So with all that, our Forex reserves have been depleting. And as I said earlier, as I mentioned, that one strong factor that we have in our favor is that we started 2022 with high level of Forex reserves. And that is something which is providing more than $600 billion of Forex reserves that we started with. That has helped us, that has cushioned us from the sharp depletion in Forex reserves that we've seen in the last few months. So we have actually seen more than $100 billion of Forex reserves depletion in the last 1 year. And very recently now what has happened is that USD, which had been strengthening strongly, the weakness has moderated, and we saw some correction in US dollar happening, mainly on the expectation that probably Fed will not be very aggressive going forward. And that has also been supportive of Indian rupee and other currencies. And we also saw some buildup of Forex reserves in the last 1 week, a very small increase. But broadly, yes, depletion in Forex reserves is a concern. And currently, we have import cover of around 8.8 months. So you can see the import cover has fallen in the last few months, but still we are at a better level than what we were, say, during taper tantrum, when the import cover was some less than 7 months. So in that sense, we are better. And over here, apart from import cover, so import cover has fallen to 8.8 level, and the concern is that in case going forward, this depletion in Forex reserves gets more disruptive, the big concern is that this could fall further, and then RBI will have to come up with some other measures to increase capital flows into the economy. The other thing is that that is on import cover. Now, if I look at my external debt, many of the economies would also be worried because of their huge external debt in US dollar, which would get impacted by the weakening of their currencies. In India's case, that concern is less because our external debt is relatively less. External debt to GDP ratio is around 20%. So less concern on that front. And even of the total external debt, if I look at the short-term debt, the next 1 year, that's even less. It is at 20% of overall debt. So our short-term debt to Forex reserve, which is a parameter of external vulnerability, is at a very comfortable level currently. Hence, there is not much worry on that front. But while the external vulnerabilities are still less, there's a lot of risk given, if the global situation worsens, and that's where we need to be cautious. So in midst of all this, another factor which is supportive is that government finances are not in a very bad shape. Fiscal deficit has definitely shot up because of all the pandemic related steps that were announced. And the budget deficit is currently at 6.4%. But the point is, and then on top of that, this year the government had to announce increase in subsidy, both food and fuel subsidy. The government had to announce cut in fuel duty to reduce petrol and diesel prices. But with all this at the same time, we have been seeing good tax revenue collection, GST as well as income tax, corporate tax. And that robust tax revenue is kind of providing comfort to government. And hence we feel that broadly, the fiscal deficit government will be able to meet the budget target, maybe exceed marginally to around 6.5%. Another positive is that the bank credit has been showing very strong growth. If I look at the data till September, the bank credit has grown by more than 15%. And in fact, if you look at the October data, it's even higher at 16% or so. And in that, it's mainly being led by retail and service sector, recording around 20% growth. If you look at credit demand from industrial sector, it's around 12%. It's relatively less. And in this also industrial sector, if I look at the credit demand from large enterprises, it's even lower at around 8%. But this 8% is also very good compared to the fact that, if I compare it to last year, credit demand from large industries was actually contracting. So in that sense, this 8% growth is good. But yes, the big question is how much of it is because of increased working capital requirement because of high inflation, and how much of it is actually for capex. And that's where, that whole discussion that I had earlier, that now capex is showing signs of improvement. So a lot of this credit demand from large industries would probably be because of higher working capital requirement, but now we are also seeing signs of capex picking up. Banking system liquidity has tightened. That's in line with what the central bank wanted. The central bank has hiked policy interest rate by 190 basis points or so. And at the same time, the credit demand has picked up and forex inflows have reduced. So combination of all this has resulted in liquidity in the system reducing, surplus liquidity in the system. And the GSEC is also inching up with the rate hikes that RBI has been doing. But now GSEC is still, if you look at the movement, it's not very sharp because of this increased expectation that probably RBI will also now moderate the rate hike going forward in the December meeting. So in fact, we are also expecting that compared, as against 50 basis point rate hike that we had seen in the last few meetings, now we expect a lower rate hike of 35 basis point in December meeting. And that's mainly because of inflation coming down and also some support from what has been happening in the forex market. Rupee, we have already discussed. Rupee has been under pressure because of dollar strengthening and also because of CAD widening and capital FII outflows that we have been seeing. But at the same time, rupee weakening is still less than what we have seen for many other emerging market currencies. So overall, this is our expectation on the economy. We are expecting in FY23 GDP growth of 6.8 to 7%. For FY24, we expect the GDP growth to moderate to around 6 to 6.5%. Inflation, we are expecting for FY23 average of 6.8%. We expect inflation to go down to around 5.5 to 5.5% in FY24. Current account deficit, we are expecting it to widen to 3.6%. Fiscal deficit, a little higher than the government's budgeted number at 6.5%. And like I mentioned, RBI rate hike of 35 basis points. And then if required, if the data, as per inflation data, there may be another 25 basis point rate hike in the fourth quarter of FY23. And rupee, we expect it to move in the range of 81 to 83 by the end of FY23. So That's it from my end, and happy to take any questions on this.
I would request all the participants to write their questions in the chat box.
I wanted to know. Hello.
Yes, I can hear you.
I wanted to know that the RBI has written a letter to the government stating why they could not stop inflation. So, any idea what the RBI has written?
Anil, this letter was not made public, so I wouldn't know what the RBI has written, but I can make a guess. So, in the letter, RBI was supposed to explain to the government that why is it that they were not able to get inflation within the targeted range, and what do they expect is going to happen going forward. So on that, probably RBI would have given the argument that a lot of the inflation, especially when it started, was because of supply side factor, because of very high global commodity prices, which was not in control of the central bank. And hence, there's little that they could have done. But having said that, after some time, because this inflation, even though it started from supply side factors, it started getting more deeply entrenched in the economy. RBI started hiking interest rate. But yes, one argument that they can take is it's because of supply side factors, because of global commodity prices being high, which was not really in their control. And now that they have hiked interest rate, the rate hikes by the central bank has an impact on the economy with some lag, with some quarters lag. And hence we can expect we can see more of the impact going forward in the next few quarters. And in fact, RBI has been able to ease inflations from the high levels of 8% or so that we had seen few months back to less than 7%. Though apart from RBI, the government also had a role to play, and the fact that global commodity prices only went down also had a role to play. But overall, inflation, as I said, is likely to inch down going forward. RBI would have given those arguments in the letter.
Regarding the dollar strengthening and the rupee weakening, so the minister made a statement that the dollar is strengthening, not the rupee weakening. So, how much do you agree with that statement?
I quite agree with that. And not just, not just Indian rupee, all other currencies have also faced the brunt of dollar strengthening. So yes, that has had a big role to play. But having said that, like I discussed earlier, though that was a strong factor, but even while that was playing down, our current account deficit is also widening. Our capital flows is also reducing in the form of FII outflows. But many of these, this CAD widening and FII outflows happening is also because of dollar strengthening. But yes, it is a combination of domestic and global factors, with global factor having a big role to play here. So I kind of agree with what the minister said.
Ma'am, there is one question in the chat box.
A view on crude is very difficult. Crude prices have been very volatile, and there are a lot of other factors apart from demand and supply that has been playing in the market. So, like you mentioned, yes, there is going to be increased demand from because of winter season. And yeah, with China opening up, coming out of COVID, maybe demand from China will also increase. So those factors are there. Then, as we have seen, we are also seeing OPEC countries cutting production to kind of get prices to the level that they want. So there are a lot of factors impacting. Overall, while we are expecting overall, while we are expecting that there is going to be a slowdown and that is going to have an impact on all commodity prices, including crude oil. But if you see, there are some supply issues too on the crude oil front. So even if the demand slows down, the supply constraints will also keep the prices high. So I think most probably crude is likely to move in the range of $90 to $95 in the coming 6 months.
Madam, recently the Shaktikant Das said that they have saved dollar for the rainy day. So, do you agree with that? Whether dollar should be more because we have to we increase the depreciation of the rupee, fight depreciation of rupee.
So yes, I agree, because that's what I mentioned even in my presentation. The fact that we had forex reserves at more than $600 billion was a big supporting factor. That's why we could sustain more than $100 billion fall in forex reserve. And that's what the RBI governor was referring to, that we had built up forex reserves, and that's what helped us at this time. So there's a question, so whether we'll go back to pre-September situation. So pre-September situation compared to what, I'm not sure. Okay, so there's a question, what's your take on exports which are going down? How much it will impact us? So it will impact us. Exports contribute around 20% to our GDP. So exports going down, and exports will go down further. Like I mentioned, the last data that has come for October, that has shown a contraction of some 16 to 17%. And going forward, it could worsen. And it will have an impact on our economy. I mentioned even in the first quarter GDP, the net exports widening was a big factor that shaved off from our GDP number. And next few quarters also, we are going to see that. I expect the CAD to widen to around 3.6% of GDP. So definitely exports slowing down will have an impact on our economy. And also not just in terms of GDP, but also indirectly in the form of, what happens to the employment situation. Because many of our export dependent sectors are also very labor intensive. So with the slowdown that's going to happen globally to the external demand and exports, it will have an impact on the employment situation also in the Indian economy. Then it will start indirectly impacting the domestic demand. So like I mentioned, while we are doing fine, Indian economy recording 7% growth when other economies are talking about slowdown and recession. But at the same time, we are, we will get impacted by this global slowdown. And the government and the central bank would be cautious of, the global development and impact of that on Indian economy. So there's a question on looking at the current economic scenario, which sectors you are expecting to perform better in FY23 and which would be impacted badly. So if I in terms of, there are two ways in which I would look at the sector performance. One would be in terms of revenue, and the other would be in terms of profitability. So if you look at the sectors, almost all across in terms of revenue growth, the sectors are recording good revenue growth. Demand improvement is happening all across. The bigger concern is on the profitability front because of cost pressure. So, we have seen sectors like cement and steel struggling with high input prices. Even for the FMCG companies, we had very high input prices in the form of wheat prices, edible oil prices. So more than revenue, I would say it was cost pressure, which has been a concern for the sectors. And hence, going forward, what happens to the input prices will have a big role to play here. And we have seen, if we look at the data for the first quarter and second quarter data that has been coming up, the profitability is getting impacted by the input prices going up. So that's something which we'll have to watch out for what happens on that front. In terms of sector, the sectors which are dependent on external demand would, like say textile, ready-made garments, gems and jewelry, they would feel the pinch of slowdown that's happening, that we are expecting going forward. And again, sectors which are dependent on rural demand, like say urban demand will do well. Sectors which are dependent on rural demand, we will have to wait and watch as to what happens on rural demand, because I feel that we could see an improvement in rural demand also happening going forward. And that will benefit sectors like FMCG and auto. So there is a question on whether we'll go back to pre-September situation on inflation. So our inflation projection is that by the end of this fiscal year, the inflation would go below 6%. And like I mentioned, for FY24, we are expecting inflation in the range of 5 to 5.5%. So inflation will inch down. But if I talk about, RBI, actually, if I look at the mid-level target of 2 to 6%, mid-level is 4%. So that we will not be able to reach even in FY24, I feel. Because tackling this core inflation is not going to be easy, because that's quite sticky and difficult to get out of, to moderate the core inflation. Because many of this inflation just gets entrenched in the form of high inflationary expectations and other parameters, and that's then difficult to moderate. Recommendation for the coming budget. Recommendation for the coming budget, I think the government, even if you see what the government had done in the pandemic years, our government did not resort much to fiscal stimulus. We did not have too much of tax cuts or apart from the subsidies which were increased, but we did not have some, more money given in the hands of people to spend, which is what we saw in many of the developed economies. And that's also a reason why they are facing the situation of high inflation currently. So I think going forward also, I do not expect the government to take recourse to fiscal stimulus measures. When I say fiscal measures, I mean tax cuts. I do not see that happening. I think the government is going to continue its focus on capital expenditure. Government had budgeted for an all-time high capex target of 7.5 trillion for FY23. I think for FY24 also, the government will have a strong capex target, and I think that's a good idea, because that will enable the economy to for a long-term sustained growth recovery, as against giving a short-term fiscal boost to the economy. So I think that's what the government should stick to. But at the same time, the government will have to take into account that the segments of the population or the sectors which will, so initially, the government had announced a lot of measures to support the sectors which were impacted more by the pandemic. I think now in the coming budget, the government will have to look into the sectors that will be impacted more by the external slowdown. So the export intensive sectors, they will need support from the government in the coming budget, because this global turmoil that I spoke about, it's going to continue in 2023 too. So it would be good for government to come up with measures to support the export sector. So do we want to take more questions, or do we want to end this now?
I think we can end this now. Thank you so much, ma'am. It was an insightful and knowledgeable session, and I'm sure that all the participants would be taking along with them immense amount of knowledge, wisdom, and experience obtained from your discussion. Thank you.
Thank you, everyone.
Thank you, ma'am.